Here are 7 mistakes that you might be making in your investments. So as a fellow investor myself, I've been investing and trading for the past 8 to 9 years. And because of that, I have been researching and reading a lot on this topic about investments. And through my various research and readings, I've compiled these mistakes across various sources into this video for you guys. So if you want to avoid these mistakes and learn investments faster and better, this video is for you. Point number 1 is timing the market. And here's what Warren Buffett has to say about it.
The interesting thing is, Charlie and I, all the time we've worked together, and I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do, or for that matter, on what the economy is going to do. We don't know.
As you can see, for Charlie Munger and Warren Buffett, the man himself, they do not actually get very affected by the timing of the market, but they are more curious. If you watch the full video, they are more concerned on whether this company is a great company in the first place. And when you try to time the market, here's a question for you by Peter Lynch.
But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16 and then it got to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. You flip a coin, you walk around the block, what do you do?
So there was a video by Peter Lynch where he was a legendary investor under the Fidelity Vigilant Fund. He actually outperformed the stock market for 13 consecutive years. The golden question is always, what do you do when the stock price goes down? And this is the most common mistake of timing the market. And if you want to find out more, you can watch in this video that just covered this topic on timing the market, and you can find out more about it. Number 2, being too attached to the purchasing price. And here is what Warren Buffett has to say about it.
It's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling.
And here's another video, also by Warren Buffett, but this is a CNBC interview.
I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them. And you're not going to pick the bottom and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it go down 50% or more.
So why did I show these 2 videos? I think a lot of people, when they invest, they are trying to get the best price. For example, if let's say your friend bought A stocks at $2 and then the market went up to 5, you'll feel that, damn, I'm buying at a premium. I could have bought it at 2. I want to get it back at least 250 or 3, then it's more worth it. And maybe for those better investors, you guys have your technical analysis, have your support levels, right? They want to come back down and get it because you feel that if you get it at a certain price higher, you'll be paying a premium or being too expensive. This may be valid for really short-term trade, but in investing, as Warren Buffett mentioned, you should not be too attached to the quote, like what he said to the quote when you're buying a farm. You should be looking at the potential that these investments can bring you. Because here's the fact, whether your friend bought this stock at $2 or you bought at 5, if the stock market went up to $10 and $15, it's both a win for you and your friend. It doesn't matter where you started. So don't get too attached to the purchasing price. And if I may quote from Warren Buffett himself, always purchase assuming that it's a blank state. There's no comparison of who bought it cheaper, what it was, what it went. It's always where this stock can be moving forward. Point number 3, that will be on missing out on opportunities. I think a lot of us are sitting on the fence on whether should we invest or should we not. Kind of similar to trying to time the market, but this is whether should you even do it or not. And here is again what our dear friend Warren Buffett have to say about it.
Is why don't you own Google and Amazon? Those two in particular. Let's take those
Well,
two.
that's a pretty damn good question, but I don't have a good answer. I definitely should have owned Google. We were using search at Geico in a significant way, so I knew the power of search. I was capable of understanding that. On the other hand, I had seen that Google was taking out Alta Vista to some degree, and I thought, maybe somebody else can take out Google, and maybe if they'd started earlier, somebody else could have taken out Google. I was always a step behind on that.
What do? Do you kick yourself? What does Warren Buffett do?
No, I don't. Because I made so many mistakes. If I tried to kick myself, my legs would be exhausted. You don't kick yourself in the investment. But, it is part of what you do.
Warren Buffett himself has also missed out on opportunities that he thought he could have made. So same for you watching out there. If you're wondering if you should be investing or not, of course, do your own due diligence and speak to a professional if you have to. But you do not want to sit on the fence for too long because there may be opportunities on the table that you may be giving away. Point number 4, underestimating the human emotions. Even in today's landscape, most people fundamentally believe that they can invest themselves. I'm not saying that you cannot. You can. Of course, they kind of forget or underestimate how much this emotion that a human can have, that we are born with it, can affect an investor's decision, and it may ultimately affect your portfolio. This is also quoted from Investopedia to show how letting emotions rule can be really detrimental to your portfolio. And what are the proven things that shows? For example, CNBC, they have a fear and greed index that measures every single day on the market sentiment, whether they are very fearful or they are very greedy. Ultimately, in investments, we boil down to these two emotions. Are we greedy currently? Are we fearful currently? Thus, it's really, really difficult to totally remove this emotion part of your investment journey. And here's the truth. Your portfolio size matters. Managing a 5 grand portfolio versus a 500 grand portfolio. As your portfolio grows, the emotions that's attached to that portfolio and the decisions that you can make or cannot make will also evolve, and there might be different reaction when it comes, right? I mean, losing $500 and losing $50,000 is really different. Of course, in percentages, they may say the same, but trust me and trust Warren Buffett himself, it's not the same. You don't want to actually underestimate the emotions that a human may have. Number 5 is not understanding the nuances of diversifying. Here's a short video to explain both of the coins.
And stock market investments are a very small portion of that number that we mentioned before, the net present value of your salary. The "do not put all your eggs in one basket" group says,
the one universal rule that idiots in finance know is diversification. It's the only free lunch. You got to diversify.
Single stocks are a bad place to invest money. You're much better off to be spread out and well diversified.
Knowing how to diversify well is more important than almost anything. People don't understand this.
The "put all your eggs in one basket and watch it" group says,
diversification, that's for idiots, right?
Diversification is for the know-nothing investor. It's not for the professional.
We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing.
So clearly, there are two camps. And also, Warren Buffett himself, he is on the side where diversifying are for idiots, for those that don't know what they're doing. But here's a surprising thing. His direct mentor, Benjamin Graham, himself holds over 100 positions. That is a differentiating strategy compared to what Warren Buffett is doing. And here's the video to show you.
Graham operated an investing partnership called Graham Newman, and in 1951, this partnership had more than 100 different positions in its portfolio. Buffett thought maybe a single stock is too little, and so he diversified into 7 holdings.
As you can see, from 1 being very focused versus after he learned, he went to 7. But at the back of this video, he didn't end up with 7 even today.
Warren Buffett's current portfolio looks like this. Still quite top-heavy, but not at all as concentrated on a few companies as he was back in the days.
He has around 40 positions and of course over other 50 operating subsidiaries. But it did not actually match Benjamin Graham's over 100 position. It did not reach that level. There are two sides to the camp, whether to diversify or not. But what determines whether someone should or should diversify? I think there are a lot of factors, and I'll just cover a few. The first one will definitely be the amount. If you are investing a really small figure, for example, if you are only investing maybe 5%, it actually does not really matter whether we should diversify or not, because the actual risk that is exposed is really minimal. It doesn't really matter. So unless you're talking about a good half your pie chart of your income and your cash assets and all that are investments, that will also change along the way. Which goes also to my next point, would be your risk profile as a person. Everybody have a different risk appetite. Are they more adventurous? Are they more conservative? That will also affect a person's decision. And last but not least, the context of how does diversifying works well. I do have clients that are top traders themselves. They can trade really well on their own, yet we still do business together, and I manage their investments policies at the back. Why do they do that? Some may say it's stupid, some may say it's not. I think the context of every individual lies differently, and that really depends on whether what's your purpose of diversifying in the first place. So all those are more important than just the umbrella on top of you should diversify or you should not. So if you want to know more about these reasons, let me know in the comments, and perhaps I'll do a full video for you guys. So point number 6 is the lack of patience. And this is also quoted from Investopedia.com on how the lack of patience affects your investments. And even as I quoted from Warren Buffett, if you cannot hold your investments for more than 10 years, you should not even hold stock. If you think a business is going to last more than 30 years, it doesn't matter, you should invest in it because it's a great business. But if you think a business is only great for 3 years, it's ultimately not really a great business after all, isn't it? I think there are too many people today in the landscape, too many get-rich-quick stories floating around, showing the so-called possibilities that you can get rich quick. But the question is, does it really? Even Warren Buffett, he only became super rich at the later stage of his life. And as Warren Buffett also mentioned, the stock market is about transferring the money from the impatient to the patient. Thus, they may be outliers, but on the realistic point of view on what really is happening, you need to invest for the longer haul. Point number 7 is omission, not commission. And here's what Warren Buffett had to say about it.
The mistakes that have been most extreme in Berkshire's history are mistakes of omission. They don't show up in our figures, they show up in opportunity costs. In retrospect, we can tell that we were very much mistaken not to do it. But Warren, we have blown
Billions and billions and billions. I might as well say it.
right. And we keep doing it
Some might say we're getting better at it.
practically everywhere. And what really costs in comparison with what easily might have been are the blown opportunities.
The biggest mistake that they have made are not those that actually showed up. It's the fact that they knew but did not do it. So for those that are still hesitating whether to invest, should you not start now, start when, is it better next time, is it better now, do you have enough money, yada yada yada. Have a proper strategy to understand how you're gonna start your investment journey, right? Because the biggest opportunity, it's not on what shows up, it's actually those that did not. Just the statistics in the past maybe 30 years of S&P 500 from TradeThatSwing.com shows this, a 10.22% per annum for the last 30 years. And for Investopedia, for a longer time frame, shows this. From 1957 through the end of 2023 is at a 10.26% per annum. Even if you invest a mere $50 to $100 back in the 1990s, would have made you a lot of money. So here are 7 mistakes that you may be making as an investor. The first one is trying to time the market. Second, being overly attached to the purchasing price. Number 3 is on missed out opportunities. Number 4, underestimating the human emotions. Number 5, not understanding the nuances of diversifying. Number 6, the lack of patience. And number 7, the mistake of omission. I hope this video helped you, and if you find this video helpful, let me know in the comments below, and may your investment journey be a good one. Take care.